Don't follow the herd. If you see a bunch of people running in one direction to invest in something and everybody's making money hand over fist, do yourself a favor, run the other way. I'm really talking about the FTX cryptocurrency fiasco a few weeks ago. I'm talking about people that lost $1 trillion of collective wealth in cryptocurrency. Solana, Cardano, XRP, Dogecoin, and all kinds of other shit coins or meme coins. I'm talking about Bernie Madoff. I'm talking about these fraudulent investment scandals that even the most successful and intelligent investors lost money in. All right, guys, before we get into it, I just want to introduce myself. My name is Dr. Jonny Walker. I'm an endodontist, as well as the principal and founder of a real estate investment firm. And on this channel, we talk about everything related to achieving financial freedom through passive investment in real estate. For anyone interested in investing passively in real estate and in syndications, we've created a sponsored due diligence checklist that everyone should consider before investing with a sponsor. That's available for free download on our website. There's a link for that in the description below. But now, let's get started. Now, when a young Sam Bankman-Fried, highly intelligent, full of charisma, entered the scene, many people rushed to invest. Even the likes of highly sophisticated and intelligent investors like Kevin O'Leary, aka Mr. Wonderful of Shark Tank. These companies that I've mentioned above, these are publicly traded companies, ladies and gentlemen, where the numbers are right in front of you, where you have access to reports, profit loss statements, and company workings that is readily available at your fingertips. And despite that, people lost a lot of money. And despite having all the resources to do due diligence, people still lost money. The problem is people are not going deep enough into the due diligence aspect, even when the information is readily available. Now, what about real estate? This is a completely different animal. Real estate, you're not subject to the scrutiny of the SEC. There is no readily available information. It is literally insider trading on who can get the best information wins. Real estate is an inefficient marketplace where there are tons of unknowns. The information is not transparent and sometimes not easily or impossible to get. And let's face it, when it comes to analyzing spreadsheets of real estate investments, the devil's in the details. And insider trading in real estate is legal. We are not subject to the scrutiny of public offerings such as stocks. And that's where fraud can occur in real estate. Some of the fraud is on purpose, which is absolutely disgusting. But then there's also fraud that's done not on purpose. And let me explain. Now, over the last few years, especially since 2020, there's been an explosion in the interest of investing in syndications. And rightly so. A lot of people are making money and they've seen it as an excellent alternative to investing in the stock market, etc. And seemingly everybody is making money. And it's kind of a situation that it's kind of hard not to make money. And so what happens is a rising tide raises all ships. However, this profitability that these people have often has less to do with their ability and has more to do with the rising market. And as a result, certain sponsors and certain syndicators become overly optimistic and falsely overconfident in their own abilities. And as a result, when there's more money, this attracts even more players to the game. That's the nature of investment, and that's talking about the herd that we're talking about. So what happens is more investor capital. What happens also? More sponsors. All of a sudden, there's more real estate operators and multifamily operators. People from all kinds of other businesses. I know one guy is running a CEO of a hospital. Another guy that was a restaurateur, had 19 restaurants, said, hey, this is just like running any other business. And they also became real estate operators. And that's a wonderful thing because there is a scarcity of affordable housing in America. But the problem, the fraud that happens is when that there's syndicators and there's sponsors that have no business being in the industry. We have been outbid and outtermed by syndication groups, where we know that the maximum amount that you can pay and make any money in a certain deal has been way exceeded by some out-of-state buyer that nobody's ever heard of that came in with a lot of capital. Now, they piece together an unrealistic expectations for rent growth and timelines, and oftentimes they're in for a rude awakening when things don't achieve unrealistic expectations. We have seen syndicators and business operators that have no being in the business. We have been outbid and outterms by syndication groups that have grossly overpaid for properties with unrealistic business plans, overestimated rent comps, and received floating rate debt with no rate caps, even in interest rate rising environment. And all of a sudden, things are changing with historic rises in interest rates. Capital markets are in flux. The volume of sales has fallen off a cliff. Things are slowing down, and that's exactly what the feds are trying to do as they try to curb inflation by rising interest rates. We are seeing distress now as a result. We are seeing apartment buildings that were once cash flowing, but now the interest rates have adjusted to a high interest rate from a very low interest rate that was locked in on a floating rate terms, and now there's no more cash flows to investors. They start withholding cash flows to investors, and they run out of cash trying to pay the debt that they can't even continue implementing the business plan. They can't continue renovating the units, so they can't even help themselves by renovating units and getting higher rent for their inventory. And expect this distress to continue. Feds have already announced interest rates will be rising through Q1 and Q2 of this year and beyond, potentially beyond. There are syndicators out there that will literally sell investors on anything that is the buzzword, anything that they perceive that people have interest in. If it seems like everyone has interest in short-term rentals, right? Then they're gonna go and pitch you a deal on short-term rentals. They may have fancy websites, blogs, podcasts, YouTube channels that makes them really seem like they know what they're doing. And the information is correct and it's excellent, well laid out. They appear to be a leader in the subject matter. They make claims that they've been doing this for years. But think about the guy, right, that goes through the entire dental program but never touches a patient, passes the boards with flying colors, and then goes back to teach academia and teach dental students about doing dentistry. Now, does he have all the didactic and academic knowledge and mastered it? Yes. But does that make him a good dentist? Right? That's the same thing with real estate investing. There's so much that you can learn from reading and regurgitating information, but nothing replaces experience. So now if you find this short-term rental, guys, are you really doing the due diligence required? Are you really doing the due diligence on the property? Are you really doing the due diligence on the sponsor or the partner that's pitching the deal to you? If a guy's track record is nothing more than investing as a limited partner in a few syndications before, and he's adept at listening to what the latest buzzwords for investors are. For example, take a self-storage unit. That's been a popular vertical and popular subject investor talk for the last year or so. So what did this guy do? He went and found a sponsor that was doing a bunch of self-storage deals, and he made a deal with that sponsor to raise capital for him. And he went on to raise a lot of money for that sponsor. Now, did anything go wrong with that deal? That remains to be seen, and I'm not saying that it will. But the point is that the sequence of events that happen is just downright scary. This doctor, syndicator, did very little due diligence on that sponsor other than being sold upon a presentation of an offering, right? He did not dig deep into the sponsor to find out, did not require due diligence about the market, the sub-market itself, nor underwrite the asset itself properly. Quite frankly, because he just doesn't know how. He had to literally rely on the word of the sponsor, who is incentivized to get you to raise capital for him. So in this situation, this doctor is not even a syndicator. He's more like a promoter that's selling the dream that the sponsor has sold to him. He has no real idea if the investment will work out or not, if it's a wise investment or not. And the second scary part about this scenario is that the number of dentists that cavalierly invested hundreds of thousands of dollars with a syndicator that without doing any due diligence either. Now, I'm not saying that this particular deal is good or bad. I'm not weighing the merits of that. I'm just saying that the amount of events and the amount of capital in such a short time period that happens was astounding to me. Let's be clear, in this business, if you don't invest wisely, you can lose your shirt. These are not small amounts of capital that we're investing. But if you take the time to learn it and get it right, you have the ability to earn tremendous amounts of wealth. So the take-home message is don't follow the herd. Do your homework and do your due diligence before you invest your hard-earned money. All right, guys, that's it for today. Hope you enjoyed it. Please like, subscribe, share with somebody that you think would also get value from it. And I want you to click on the next video to continue your wealth building journey. You're going the right direction. Let's go, guys.